Assalamualaikum and good morning, madam. Today, our group will be presentation about the application of agency theory in addressing ethical issue, a study from accounting perspective. The first one, agency theory is a relationship between a principal and agent where the principal delegates decision-making authority to the agent, affecting resource allocation, coordination, pricing, costing, compensation, and incentive. This can lead to agency costs and problems such as inefficiency and information system can occur into type. The first one, adversary, where insider have more information about the firm state and prospect and the outsider. Second one, moral hazard, where management activity are not sufficiently known to shareholder causing unethical action. Agency theory is based on assumptions about human nature and organizational factors such as a conflict, efficiency, and information system between principal and agent is in business. Principal are shareholder, while agents are company executive to maintain interpersonal relationship and motivated imply it is essential to appreciate and provide sufficient information to superior. For second one, historical of agency theory. The first one, agency theory is a concept economic and organizational behavior that focus on the interaction between principal and agent. Second, it addresses potential conflict of interest when one party, the agent, is interested with decision making or action on behalf of another party, the principal. Third, the central concept is the conflict of interest between principal and agent, which can result in the principal-agent problem. For agency theories suggest various process and tactics for resolving thesis disputes. 5. It is used organization to examine the connection between top management and employee. 6. Incentives such as a performance-based compensation or stock option are established to align both side interests. 7. Monitoring and monitoring procedures are put in place to ensure the agent behave in the best interest on the principal. Agency theory is a fundamental framework used by economic management theory practitioners to explain and handle the interaction of organizational relationships and decision-making process within firms. And the last one, in financial market, agency theory have investor analysis and regulator understand the behavior of agent and how it affects the firm's value. And the last one, my part, ethical issue in the accounting, window dressing in fraudulent practice in the capital market where fictitious documents are modified to appear to exist. 2. It involves beautifying investment portfolio before they are presented to shareholder or client. Third, window dressing begins at the end of the quarter where investment managers create financial report and folio list. 4. If the financial report data is not accurate, window dressing is carried out, selling shares that are reported to produce greater loss and replacing them with shares expected to produce greater short-term profit. And thus, window dressing violates the professional code of ethics for accountant as it creates fraud or manipulation financial report.
My name is Nurul Afifa. I represent on the agency program in accounting. Okay, The first agency problems in accounting is the separations of ownerships and controls. This is where the ownerships of the companies and also the managers or agents who in charge in controlling the companies have like have different interests which for example the shareholders or the executive and then the managers which is the agents that taking care of the companies have different interests in on how they want to operate the company itself. And then secondly, the information asymmetry, as we know that the one that taking the one owners of the companies and the one that take controls of the companies different persons. So the information's also different. It's obvious that you can see that because managers or agents are the one that taking care of the company, taking control of the company, so they have more information on the company itself. We get the details how the operations of the company works compares to the owners of the company itself. So this one is also can have make conflicts, um, have interest conflicts as the previous point, the first one. And then thirdly, divergent goals and motivations. Yeah, so as we can see, the shareholders will have a um, a long term a long term goals that they want for the companies. They want the benefits for all the shareholder itself. But for the manager itself, they aim they aim on their personal interest of their goals when leading the company. And for its incentive means and women, which the companies like the managers of the companies might give only receive like a short term benefits, uh, while the shareholders will have a long term benefit. This also can be a conflict for the decisions. And then the last bit is lack of effective monitoring and control mechanism, which can say that it's lack of internal controls because the managers or agent that taking controls of the company have more freedom in what they want to do to the company towards the companies, and they will act based on their self-interest rather than what the best for the principals for shareholders. Next is mitigating ethical issues on the agents and the agency problems. So first, the firstly is the, f- the firstly is the firstly is incentive alignments. Okay, next is the mitigating ethical issues. Firstly is incentive alignments, where there's for the performance competitions, like the manager composition to perform a matrix that reflects the principal goals, such as stock price, profitability, or other relevant indicators. And then other than that, they also offer stock options to the managers so that can align with their interests with shareholders by making the managers parts of the owners or co-owners of the company itself. So it's also like if the stockholder rise, then the manager not just the shareholder, but the managers also receive the benefit of. And then next, the monitoring and oversight, whereas um, the board to ensure the effectiveness and the independence of board of directors and oversees and management activities and decisions. Also, for the auditors to conduct regular internal and external audit to ensure that the transparencies and the accountability of the company. Thirdly is the transparent reporting, whereas this is related with the financial disclosures that they disclose the financial reportings to reduce the information asymmetry. Whereas before this already says how the principals and also the agents have conflict in information asymmetries. And then also, it requires the regular updates and the communication between the managers and the owner of the companies regarding the performance of the companies and also the strategy for decision making on the companies. Next is the corporate governance policies. This is related with the ethical ethicals to be implemented. So in order to do that, it's like need to conduct or during the outline that acceptable behavior and decision making process, and also develop programs to ensure the compliance with laws, regulations, and ethical standards. Then next, the stakeholder involvement. First, this is first the shareholder in the company involved in the meetings and encourage everyone to participate in the shareholder meetings to voice their concern and to provide or to share their strategic decisions for the companies. Also the stakeholder engagements with the shareholders, such as the employees, the customer, so that also to ensure that the process for the ethical considerations. This is reducing information asymmetries by open by create a channels or like a group chats for the principals with the which is the owners and agents with the manager of the company to share like relevant information or important information timely and accurately. So the principal will not miss any updated about the company. So and then other than that, we also to for that to ensure that all the data are accurate and the shareholder receive the real-time data information to make a decision for the company. Next is cultural and ethical training. Whereas, the company provide training program to focus for the employee, focus on the ethics and corporate governance for the both managers and employees. Also for the leadership's development to emphasize their leadership skills. Next is regulatory compliance, whereas they make legal standards and regulatory requirements to ensure compliance and avoid ethical branch. And also, there's sometimes like a big company where actually we thought that there's no problems, but actually there's internal problems like fraud and like fraud such as fraud. But sometimes the employees um, cannot voice out about it or they will get some penalty or affect their career. So so they choose to be a whistleblower. So sometimes the whistleblower itself, the one that you become whistleblower, although they did a good thing, um, but because of the strong the powers that the owner have, so sometimes the whistleblower career will affect. So it's better to establish and protect the whistleblower mechanism to encourage uh, them to report any unethical behavior in the company without fears. Okay. So by implementing all the strategies, company can mitigate ethical issues inherent in the agency theories, to ensuring that the interests of the principals and agents are more closely aligned, and that ethical behavior is promoted throughout all the organizations. Next is the critics and challenge is that involve the critics and challenge in agency theories that towards ethical issues in accounting. So firstly is information asymmetry. The critics for information asymmetry is, while the agency theory emphasizes in reducing the agency theory emphasizes in reducing information asymmetry. Accounting itself the can be opaque and complex by making it difficult for principal, which is the shareholders, to fully understand the financial statement and other disclosure. Because because the shareholders might be not all people can understand what in the financial reporting. So the challenge is for them to simplify the financial reporting without losing any important details, and enhance the financial literacy of stakeholders that can help bridge the information gap. Okay? And then next is the short termination. First, the critic is incentive that short term performance metrics can lead the managers to focus on the short term gains at the expenses of long term sustainability and ethical considerations. So the challenge is to balance the short term performance incentive with long term goals and ethical standard is necessary to prevent harmful practice like earning management of fraud and fraudulent reporting. And then the thirdly is ethical dilemmas and conflict. The third is ethical dilemmas and conflict interest. Thus, the critic is um, agency theories agency theory may not adequately address the ethical dilemma and conflict of interest that accountants face, such as pressure to manipulate numbers to meet the target or the influence of personal relationships. Sometimes the accountants and also like the managers of the company is someone that we know, so they have a conflict of interest, whereas um, in order to make the financial reporting looking nice, like the profit is nice, they need to change the numbering to maintain it so it will not be obvious in the audit. So the challenge is for establish strong ethical framework, independent oversight, and clear protocols for handling conflict of interest that can mitigate these issues. The lastly is the complexity of modern corporations. So for the modern corporation, complexity and global operation can exacerbate agency problems, making it harder to align interests and ensure the ethical practice across diverse regions and cultures. The challenge itself is to implement consistent ethical standards and governance practice globally while respecting the local custom and regulations. Regulation is delicate balance to achieve. So for the overall agency theories provides a useful framework for understanding and addressing some ethical issues in accounting. It, but it must be complemented by other approach and considerations to fully address the complexity and of ethical behavior in the accounting professions. That's all from me. Thank you.
Thank you, Nurul Afifah binti Muhammad Ali. So for next slides, I will continue with empirical study and case analysis. So for case study 1, I choose the case study the impact of agency costs on earning management evident from publicly traded companies. So I will review the empirical study and case analysis that have applied agency theory in this case study. So for methodology for this case study is proxy for agency cost, which the study used several proxies to measure agency cost, including ownership structure, which is the proportion of share held by institutional investor versus individual investors. So next, the board composition, which is the ratio of independent directors to total board members. Finally, executive compensation is the structure of executive compensation, particularly the ratio of performance-based pay to total compensation. So the finding in this study analysis, it found a significant positive relationship between high agency costs and the extent of earning management. So key findings include dispersed ownership, where company with a more dispersed ownership structure were more likely to engage in earning management. For example, a higher proportion of share is held by individual investor. This is attributed to the lack of effective monitoring by individual investor compared to institutional investor. So the next key finding is board composition, where firm with a lower ratio of independent director were more prone to earning manipulation. Lastly, the company with a higher proportion of performance-based executive compensation exhibited more honest management. This suggests the performance-based pay can incentivize managers to manipulate earnings to meet short-term targets. So the study concluded that high agency costs resulting from misaligned interest between manager and shareholders significantly contribute to unethical accounting practice such as earning management. So next, I will continue for case study 2, which I choose ethical dilemmas in financial reporting, a case analysis of Enron. So this case focused on Enron, a company that collapsed in 2001 due to one of the largest accounting frauds in history. So the researchers conducted a comprehensive qualitative to understand that ethical agency problem that led to Enron's downfall. So the data collection from the research study review a wide range of sources, including court document, financial statement, internal communication, and media reports. Additionally, the researchers conduct interview with former Enron employee, industry expert, and regulatory official. For the analytical framework, the analysis was guided by agencies theory, focusing on the conflict of interest between Enron's executive, which is agent, and its shareholder, the principal. So next, the key finding found in this case study is the off-balance sheet financing, which Enron's executive use complex financial structures such as special purpose entities to hide debt and inflate profit. These practices were aimed at misleading investors and maintaining high stock prices. So next is revenue inflation. The company engaged in aggressive revenue recognition practices, booking future revenue as current income to meet earnings targets. This manipulation was driven by the desire to meet Wall Street expectation and trigger executive bonuses. So lastly, there was a lack of oversight where the board of director and external auditor failed to provide effective oversights. The board was criticized for its lack of independence and its close ties of Enron management. The external auditor were found to have conflict of interest as they provide both auditing and consulting service to Enron. So the study concluded that several agency problem characterized by misaligned incentive and a lack of effective oversight were at the heart of Enron ethical failures. Lastly, for the conclusion, the literature review of empirical study and case analysis applying agency theory to ethical issue in accounting provides several key insights, which is first one is alignment of interest. Because the birth study underscore the importance of aligning the interests of manager and shareholder to reduce agency costs and prevent unethical accounting practice. Secondly, for the corporate governance, effective corporate governance mechanisms such as strong board oversight and independent audit are crucial in mitigating agency problem and ensuring ethical financial report. Next, the structure of executive compensation plays a vital role in either mitigating agency problem. Performance-based compensation without proper checks can incentivize managers to engage in earnings management. Next, role of external auditor, which the Enron case checks on financial reporting, conflict of interest such as those seen with Arthur Anderson can severely undermine the effectiveness of audit. Lastly, the regulatory environment. The regulatory environment plays a significant role in shaping corporate behavior. Next, I will continue the importance of applying agency theory. The first one is predictive power, which is agency theory provide a robust framework for predicting and understanding the condition under which managers might engage in unethical behavior. So by identifying factors that contribute to agency costs, stakeholders can take proactive measures to mitigate this risk. Next, policy formulation, which insight from agency theory can inform the development of policies and regulation aimed at reducing agency costs and promoting ethical behavior in financial reporting. For example, regulation that enhance board independence and transparency can help align the interests of managers and shareholders. Lastly, corporate governance. The theory highlights the importance of governance structures that align interests of manager and shareholders, thereby reducing the likelihood of unethical practices. So effective governance mechanism can serve as a deterrent to managerial opportunism and promote ethical behavior. Lastly, the recommendation. The first recommendation is for practitioner. So the first point, implement robust internal control, which companies should establish robust internal control and governance mechanism to monitor the managerial behavior. The second was the design balance executive compensation, which executive compensation package should be designed to align long-term interests of manager with those of shareholders. So this can be achieved by incorporating long-term performance metric and clawback provision in compensation agreements. Lastly, enhance board oversights. So companies should ensure that their board are composed of a majority of independent directors who can provide effective oversights. Next, for policymakers, we can develop stringent regulation that require greater transparency and accountability in financial reporting. So this include mandatory disclosure of related party transaction and off-balance sheet arrangement. Second, mandate stronger oversight mechanism such as independent board member and internal audit to reduce agency costs. Lastly, promote ethical standard in the accounting profession through education and certification programs. Encourage a culture of ethics and integrity can help prevent unethical behavior. Lastly, for researcher, we can conduct further empirical study to explore the impact of different governance mechanism on agency cost and ethical behavior in various contexts. This can include cross-country comparison to understand the role of cultural and institutional factors. Next, investigate investigate emerging issues, such as the impact of digital transformation and artificial intelligence on agency problems. So understanding these trends can help develop new strategies to address ethical challenges. Lastly, collaborate with practitioner and policymaker. Researchers should collaborate with practitioner and policymaker to translate their finding into actionable recommendations. So this can include developing practical tools and framework for implementing effective governance practice. So that's all from our group. Thank you.